time. Hi, so I'm here at the Minneapolis Area Association of Realtors talking to our Director of Governmental Affairs, Eric, and he's going to talk about how the new tax bill is going to affect homeowners, people looking to buy a home, or investors. So I guess to start off, it's pretty dense here. The summary is 23 pages, so there's a lot to go over. But what do you think the highlights are of just how this is going to affect your average homeowner?
Well, I think that's a great question, and that there's actually impacts for your average homeowner. There's also going to be impacts to people that are for realtors themselves, the way that they run their businesses. But then also, if you're involved in any commercial real estate, there's going to be some of those impacts as well. We can't really necessarily cover that all here today. I'm glad you're talking about the summary because there's 23 pages worth of summary. And these are just the tax provisions that have to do with the major subject of real estate. So if you think about the entirety of the tax bill that took 31 plus years to get passed this last December, this is what NAR has put together as may touch your business or may touch the business of the homeowners, buyers and sellers that you work with. So there's even more to come on this. Additionally, there's more to come on this in terms of the legislation has been passed, but the rules, the IRS having to catch up, and those kind of issues are all going to come to light as the year goes forward. And we'll be keeping an eye on those. There'll be updates in Mar's newsletter, updates from the National Association of Realtors as well, and maybe even more updates to the summary and moving pieces as we go forward.
So what about, I think for a lot of homeowners, the that 700, what's the number?
750,000 is the mortgage interest deduction. Previously, the mortgage interest deduction was capped at a home value of $1 million. So, which didn't mean that if you had a home at $1.2 million that you didn't get the benefit of the mortgage interest. It's just up to that cap. Mm-hmm. So, and at previous versions of this, mortgage interest deduction was under attack completely, and they wanted to throw mortgage interest deduction as a tax benefit to homeowners completely out the window. The first house version was at $500,000, so $500,000, and the first Senate version kept it at $1 million. So we were pretty confident, even going into negotiations, that they were going to come somewhere in between, and that's where they've ended up at the $750,000 cap. So that means if you're carrying a mortgage note at $800,000, you can still get the MID equivalent on your taxes to up to the $750,000 of your $800,000. Of course, if you're at less than that, $250,000, you could take the mortgage interest deduction. But that's going to be subject to a couple other things that I'm sure you're going to want to talk about.
Yes, absolutely, I do. And I think that the thing is, for us, with just going back to that number, here in Minnesota, that seems like a lot, right? Like yes. $750,000, that's a luxury home. But in other places in the country, your San Francisco's, even probably Chicago, that's not necessarily that crazy, right?
It isn't. And when you look at the coast, and if we had our researcher in here, or if we pulled up our housing stats, obviously the median price home ended last year at about $246,000. So you're saying half of all sales are above that, and half of all sales are below that. So, but that's the sweet spot. But on the coasts, New Jersey, California, other places, $750,000 in the LA area, it can end up being a starter home. Moreover, on the $750,000 mortgage interest deduction number, not only just what individual markets are and what those homes start at, this bill, which is good for 10 years of taxes, tax for all intents and purposes for 10 years, it's not indexed to inflation either. So $750 today and $750 10 years from now, if nothing else changes in Congress. So yeah. You're talking about markets that are already well above that for starting homes in those high-cost areas, and then it won't change or move with inflation either. It's because it's not set up in the law to do that. So, it's an interesting place to have landed.
And we're obviously, I think people know, seeing some pretty tremendous growth over the past 2 years just in the Minneapolis area. So, 10 years, it's not hard to see how we could...
Yep, prices could be up, and it could be bumping more and more people up over time. So
what about the people with the houses that are well under that 750, what are they going to see?
Well, I think it's important that people distinguish between the rhetoric of what they hear. These days, people either are watching CNN, Democrats watch CNN, or Republicans watch Fox News, and depending upon which channel you watch, you think this tax bill is either great or bad news for you. Mm-hmm. The reality is this bill is kind of a mixed bag. It does have savings in a couple different ways, and I can talk through those here in a minute, but it does have tax savings for most individuals, and they accomplish that in two ways. One, it's being accomplished because the tax rates are lower at every level except the bottom. So the 10% rate at the bottom stays the same. The previous 15% rate converts to a 12% rate, 25 to 22, 28 to 24, 33 to 32, 35 and 35 are the same, but the top end 39.6 to 37. And that's just regular earned income, what's at the top of your W-2, but almost all of those being lower. So that's how tax savings is realized for the average person. Some folks may have already seen their regular paycheck earning individuals may have seen that their withholdings have already changed, and so the median area median in many Twin Cities, people may have already seen $70 to $100 additional in their 2-week check, and that is based on the changing of the withholding tables because HR departments have adjusted the withholding tables based on tax advice from the IRS because of these expected rates. So as you all know, what's withheld from your paycheck is meant to be roughly equivalent to what you may owe at the end of the year, and obviously we're heading up on that tax season now. So that first way, all the rates being lower, is how people are realizing tax savings. And I want to make sure people understand that the information we're presenting here is not partisan in any way. It's not about Republicans or Democrats or whether you were for this bill or against this bill. This is now passed, and so this information is all here for us to look at in an objective way as possible. So the rates are lower. Additionally, they've doubled the standard deduction. The standard deduction for singles has gone up to $12,000, and for married filing jointly would be up to $24,000. The difficulty with that is how that plays with all your other stacked deductions and your itemizations. So for a married filing jointly, you would have to have more than $24,000 worth of deductions before it would be advantageous for you to take those deductions instead of just the standard deduction. So you'd need, call it $24,100 of itemized deductions before you would even file that way. Tax purists, Republicans would say, well, that's more truthful, that's a more clear way to actually do the taxes. Unfortunately, the standard deduction bumps up against the mortgage interest deduction. Right now, we know that people that have a mortgage and are in their first 12 years of home ownership with a fully front-end loaded 30-year fixed mortgage are going to pay the most interest in their first 12 years of home ownership, because that's where you make a payment and all of your payments going to interest. Mm-hmm. So your total at the end of the year for paid interest is going to be larger in your first year of home ownership. Under this tax plan, if you don't itemize and you don't claim that mortgage deduction because you do take the standard deduction, you're not really realizing the benefits of the mortgage interest deduction. Mm-hmm. The long-term concern for the National Association of Realtors as an organization and for our members and a lot of homeowners is that the mortgage interest deduction may go away the next time they make changes to the taxes because utilization has been so low. On that side of the coin, the mortgage interest deduction has been on the tax books for over 100 years. And so 100 years worth of Congresses have decided that mortgage interest deduction has been good for home ownership overall. I think what we fell victim to was coming off the last crisis, and the mortgage interest deduction as a taxable benefit to the taxpayer was really at its weakest point, and then tax reform came along right about then. So I think as a taxable benefit, it ended up being a victim to a certain extent. But
so, and this is probably a big question, do you feel like overall this tax change is just going to make home ownership look less beneficial from a tax standpoint. Obviously, we can talk about the many other benefits of home ownership, but just people who are thinking about, hey, this is going to work out well for me financially, tax-wise.
Yeah, definitely. I think you're absolutely right on that. And I don't think taxes necessarily, and you guys know as realtors, you working with buyers and sellers every day, the taxes aren't probably the highest thing on their list. Mm-hmm. They're on their list somewhere, but it's, schools and parks and trails and a lot of other, closeness to amenities, closeness to work, a lot of those other concerns come up first. But taxes is still something people do consider when it's just a decision between, do I continue to rent another 3, 4, 5, 10 years, or do I purchase ever? And I think what our concern with this bill and the reason for the call for action, which we did great on, the realtors did a really good job. And a lot of the provisions that we talk about that have been made better were made better because of the advocacy efforts of the members, because of those call for action responses, and because of one-on-one with our members of Congress. Our realtors know them personally one-on-one, and we're able to say, hey, look at this provision again, take a second look here. And a lot of the changes that were made were made because of our efforts. So I don't want to underplay that. I definitely wouldn't also oversell it too. I mean, a poorly proposed bill from the beginning, made marginally better by our efforts, is still kind of just a marginal bill. But back to your specific question, I would say that this bill has chipped away at the renter versus buyer benefit, at least from a tax standpoint. So you can't say the results of this, you can't say, as if I was a renter and I was thinking about becoming a buyer, the benefits are now less, and you can't say that they weren't. So I think it does become a consideration. I think it's something we're going to have to be concerned about over the long haul. I think if these tax changes, like a lot of government, are an experiment, then we definitely need to be continuing to monitor and do our due diligence over time and make our voices heard if there's going to be any changes to this bill now or in the future as well. So I do worry about a renter now paying, $2,000 a year in taxes, and on a buyer that only, that ends up paying more in taxes because they bought. Or and we do have some examples of that, and that's available through this. And so it could be potentially deleterious for a homeowner as compared to a renter. And we've already got price pressures as it is, low vacancy rates, but rents that are going up. It's still good to be a homeowner because for the most part, even at the median household prices, you can get a mortgage for less than you could pay monthly rent. And I think when people do some of that math, that might kind of mitigate some of this damage in the tax. But I think our message to Congress was, home is not where you want to make these changes.
Yes.
So.
And, this might not be for everyone, but I know you were talking a little bit about that $10,000 cap for the taxes. So we are in a very lovely area now, and a lot of the homes have quite high taxes, which maybe not everyone is experiencing, but can you talk a little bit about that cap?
Yeah, so one of the things they were considering when they went through this bill was what to do about the deduction for state and local taxes. State and local taxes, abbreviated to the abbreviation SALT, S-A-L-T, which just means state and local taxes. In most places, state and local taxes end up being your property taxes, like in Minnesota, but in some areas that have like San Francisco and other areas that actually have a pretty significant city tax, local tax could fall into that bucket as well. So SALT, or state and local taxes, end up being this larger bucket. But which parts of the bucket, which part of that bucket then end up being largest varies by area. In Minnesota, it's generally going to be the property tax because there are no local income taxes. So the property tax cap is at $10,000. There previously wasn't a cap on property taxes, and so this is going to be an impact for some folks. If you pay more than the $10,000 in property taxes, you will not get the full benefit of taking, having that number removed from your federal income taxes. The problem with that is not really from any other standpoint other than it's really double taxation, because you have to get a job, earn money, pay pay the
taxes.
property tax, and then as it was before, you would, okay, I've paid for my local property tax. Now I can take that off my federal income tax return because I shouldn't have to pay twice. But as it is now, you will have to pay twice. You are paying twice. You're both paying tax. You're earning money, paying property tax, and then paying as if you earn that as well. So, and 10,000 is a limit. It's capped. High cost areas again are impacted by this. The 3rd district will be impacted by this for some number of property owners, and we've estimated that you'd have to have a property value in the 3rd district in Minnesota of about $525,000 before you're probably paying more than $10,000 in local property taxes. But there's still a lot of properties that are in that category.
Absolutely.
And then again, just back like to the limits on the mortgage interest deduction, areas like New Jersey, areas like California and other high-cost areas across the country definitely have an issue when it comes to the $10,000 cap, because a lot of localities, the property tax is all that people, is a very, very big piece. So having to pay double taxes on that, having this provision change, I think this is another thing that just chips away at the value of homeownership. Put that back on.
While you're doing that, so investors. So we talked about kind of our average homeowners, but real estate investments still super hot. People buying up duplexes, multifamilies, and I've had a few of my investors ask me first of all about capital gains tax, and in the past it was possible to avoid that, having lived 2 out of the last 5 years in your property, and I think that's changing now, right?
Well, it was actually proposed to change, and they were going to go from 2 out of 5, and then you'd be excluded from capital gains to 5 out of 8. This is another one where realtors and a couple other groups out there really turned around and said, wait a minute, you can't make this change. One of the groups that responded to this was veterans groups, because people that are active military or in reserves tend to move more often than once in 5 years, for example. Yeah. So they're more likely to be in that 2 to 5 year. So this one, yes, this is an example of one of the original bills was taking us from 2 and 5 years of capital gains exclusion to having to live in your home 5 of 8. But in the end, they kept that. And that was a significant victory for NAR and for our members across the country, because, I think people, in half a generation ago, people would move, we would say people move every 7 years. That became an adage and an axiom in real estate. Then we had the market crash and nobody moved for 10 years. Yeah. And now we're back to a more normal market, and 2 and 5 seems like we're right in that sweet spot. I'm glad it didn't change. Having gone to 5 to 8, I think would have hurt some folks. What that literally means is had they made that change, if you lived in your house 3.5 or 4 years and then you sold, and the bank note was for $200, and you sold for $250, you're now paying tax on the $50,000 gained. But not on the way it ended up. So I guess the way it remained the same. The only way to really own capital gains would be to stay in your house a year, sell, and then but have some large gain too. There's also there were also proposed some income restrictions on that, and that has changed as well. So they took those out. So they had previously had it would move up to 5 to 8 years, and if you were a highly paid individual, more than $250 as a single or $500 as an individual or as a married couple, then you would have to. They would phase out the value of the capital gains to you. So you'd get the full value if you were under those income limits, and you'd get less and less and less the more you made above certain income limits. But that's not a feature either. So
yeah. So right now the capital gains mostly affects investors who are buying up investment properties, but the proposed change would have affected.
Everybody. Every sale.
Yeah.
Yeah, and when you look at the Twin Cities, 16 county metro area, we just did our stats report here at the end of January. You're looking at 61,000 transactions last year. that our members throughout the Twin Cities were engaged on. So that's twice as many sides, right? So 120,000 sides last year, and potentially every single one of them could have had a taxable gain issue. Some very large percentage of them if that change had occurred. So getting that to stay as is or not change to the way it was proposed is a major victory. So,
and then the 1031 exchange. Probably not everyone knows what that is, but important for some people. So do you want to just speak to just generally what that is now and how it might change?
The National Association of Realtors has been concerned for a number of years in advance of. So you have to understand that we haven't had tax reform since 1986. Reagan was in office. It took them 10 months to do it after he was reelected in his second term. And so it's been 30 plus years, and now we have a change in taxes. For the last 3 years, NAR had already been ramped up on taxes, talking to every member of Congress. And the second or third item, beyond mortgage interest deduction and some of the things we've already discussed, was the 1031 exchange. The 1031 exchange is an area of an IRS code that says if you're involved in commercial real estate and you own one property and you're doing it to buy a similar like-kind property, like-kind exchange, that you wouldn't pay capital gains on that sale. The thought being, hey, we're not, John Smith, commercial realtor in any place USA, who's buying or selling a shopping mall to buy another one, or a strip mall, or any kind of commercial property to buy another one. Why would he or she do that if they're going to have to pay capital gains? They're essentially losing the capital gains and have to reinvest. If 1031 exchange, like-kind exchange, wasn't in place, people would be less incented to move commercial property. There'd be a lot more vacancies in commercial property, and really the concern ends up being to where's their incentive to do that, and then so you get a gain from selling your first one, but you have to subtract off what you lost in the capital gains, having to pay the capital gains tax. So maybe you only reinvest in the next property to a lesser value, and that doesn't. But as that trickles through, it doesn't help folks continue to buy and sell commercial real estate. So 1031 has been in place for a long time. It was in previous versions before this bill came to its final. There was proposals to get rid of it. Part of what had to happen in this tax bill was the total cost scoring needed to be held under $1.5 trillion. And so every provision in this bill had been scored with a dollar amount. Well, if you take 1031 exchange out, it amounts to X dollars, keeping us under this cap for the purposes of passing the bill. So in the previous versions, 1031 had been kept out, but now 1031, as it existed before, remains viable options. One of the chief things that people critique about 1031s is that it's somehow commercial realtors just avoiding paying taxes. It's not an avoidance as much as it is a deferral. So I sell commercial property, I sell a strip mall, I buy a strip mall. It's not that I'm never going to pay capital gains on the fact that I own this property and it's going to appreciate and I'm going to benefit from that appreciation. It's just transaction to transaction. If you hold it too long or you don't reinvest it in a timely manner, you're not going to be able to take advantage of 1031 anyway. So it's not an avoidance, it's a deferral, and it's meant to keep the commercial real estate industry consistent and kind of ongoing. So.
Perfect. So is there anything that we haven't talked about that you think is key for people to understand about this?
I think people should realize that the tax bill has passed. We know a lot of the policies that are in it and the places that might impact your business, might impact homeowners, buyers, sellers, and other real estate investors. Unfortunately, what gets passed in legislation has to be moved into the rulemaking realm. The IRS has to write these rules. If you've ever filed your own taxes or read an IRS form and then the corresponding instructions, that's what we're talking about here. The agencies are going to have to write the rules that support the policy that's passed, because a piece of legislation that goes through Congress doesn't have every It has the major brushstrokes and then leaves it to the agencies to implement. So literally throughout, people think, oh, tax reform's done in December of 2017. No, literally throughout all of 2018, there's going to be updates on the tax provisions, what they mean, and how the agencies are going to interpret it. One of the ones that I think you and I were talking about previously was that no longer are you going to be able to take money out with a second mortgage and have that interest be deductible unless the proceeds are used to substantially improve the primary residence. This is gonna be an impact to people that do take out money for purposes other than improving the property. So you won't be able to take out a second mortgage to buy a new boat, or even potentially, and not to buy a cabin or get money for a down payment for a cabin, at least without a tax liability. You could still do it. It's just you'd have to have that built into your strategy. But you wouldn't be able to take money out for four-wheelers and boats and other toys, I guess that some people call it. But even the words substantially improve the primary residence, that all has to get defined yet. It's in the bill. What that means, what it qualifies, what tests, what stipulations, that's all stuff the IRS is going to have to, and other agencies are going to have to put limits on and create rules around. So more to come when it comes to the tax bill on each individual provision and what it means and how it gets implemented into the future. The other thing I would tell people is realtors are a good source of information when it comes to tax policies that could impact real estate, but please definitely get yourself, consult with a tax advisor.
Yes.
This is not legal or tax advice. This is just what we know from having followed this bill for a number of years and then having come to conclusion in December. But more information to come. There's plenty of provisions here. I think there's provisions in this bill that members of Congress probably don't even know much about, and even they are learning more and more each day when it comes to this bill.
And is there a place that people can access this lovely summary that you guys have put together?
Yes, if you go to the National Association of Realtors website, so realtor.org, and if you were to go to the first drop-in box and put in just 2 words, tax reform, you'll get taken to a page, and then you could download this document. This document has 23 pages to it and attempts to highlight every taxable provision that could potentially touch real estate as a home buyer or seller, or as a realtor in the business, or even as an investor, as you were talking about. So a lot of information in here, a lot of things to get up to date on, and then definitely find a good tax professional.
Yes,
and
absolutely.
create that relationship early in 2018 because the rules are changing.
Yes, and I will put the link to this in the comments, and then if anyone watched this and has additional questions or needs anything from me, you can either send me a direct Facebook message or call or text 612-729-7239. Thank you.
Thank you.